Okay, good afternoon and welcome back to our options education webinar series. Today we're here to talk about generating consistent income on your portfolio using cover calls. We're going to specifically talk about selling cover calls using weekly options because that's really where we can maximize our income using this particular strategy. So let's go ahead and get started. Cover calls is not necessarily the most exciting or the sexiest strategy to talk about, but arguably I think it's the most important strategy that we should be looking at as options traders, regardless of whether you are an equity investor that's never traded an option before, or if you're an experienced options trader. This is really a strategy that should be in every single investor's toolbox because this is the only strategy that allows you to generate income without adding additional risk to your portfolio. And that's a really important thing to understand because that's why this is the most popular strategy that's traded on options. This is why almost 50% of investors will sell cover calls on their equity positions to add yield. And it's a great way to induce income streams into your existing portfolio while allowing you to exit your trades at the targets that you expect the stocks to appreciate to. So those are some of the examples that I want to go over here today. I'm going to talk about cover calls as a strategy to start off with. I want to cover who should use it, which is really everyone, and that's something that I want to help convey that message here today. And then we'll talk a little bit about what are the best practices for selecting expiration dates and strike prices, because that's really where I hear a lot of users struggle with when you're using the option chains, trying to figure out what expiration date and what strike price. We'll talk a little bit about what methodologies you should be using to select the appropriate expirations and strike prices for your portfolios. But the goal of this webinar here today is I want everyone to leave with a clear understanding as to how to implement cover calls on your portfolio. So today we're going to spend about 20 minutes on the slides talking about the strategy itself and best practices. But I want to spend as much time as possible going over live examples of real stocks and how you can quickly find the cover call that matches your portfolio and your risk tolerance in a few seconds with options play. So that's the goal here, is that after you finish this webinar today, not only do you understand the strategy and know how to implement it, but you have the tools to actually be able to deliver that for your portfolio. So just before we get started, a bit of housekeeping. Number one, for those of you that are familiar with options play, welcome back. For those of you that are brand new to us, please, for the tools that we're going to show you here today, if you want to take a look at it, you can sign up for a free 30-day trial at optionsplay.com. Membership starts at $50 or $500 a year. And what I will do during the webinar is I will reference a few different things. So the important links that I'll be referencing, I will send to everyone in both the recording and the slides that I'll send to everyone about half an hour after we finish here today, so that you can have access to these important links. So we record these weekly webinars that we do. So sometimes I reference previously recorded webinars, or if you're interested in another topic, please make sure you take a look at those slides because we have links to all of those webinars. We also send out daily trade ideas for those of you that are interested in options trading ideas. But most importantly, for those of you that are still learning how to trade options, if any of the terms that we talk about you don't understand, I highly recommend you to take a look at the Options Industry Council, optionseducation.org, a free resource available to everyone. Great resource to learn more about options trading and some of the topics that we're going to cover here today. So with that, let's go ahead and get started. Today, what I want to cover is a few basic things. Number one, what is a cover call? This is for those of you that are brand new to options trading, understanding what the strategy is. Even if you understand what a cover call is, or perhaps maybe even if you've traded it before, I'm hoping to bring a different perspective as to how to go about thinking what a cover call actually is. And it's really thinking about the stocks that you own and how to exit those stocks at a profit. That's really one of the best ways, in my opinion, to think of cover calls. Then what I'll talk about is why should you utilize cover calls? Meaning, what do you actually get from selling cover calls? Not just the income stream, but what do you actually get in terms of different scenarios or different outcomes compared to just outright owning the stock. Then we'll talk about the selection process for how to select the appropriate expiration date and strike price to sell cover calls on your portfolio. And then what I want to spend quite a bit of time on, as much time as possible, is actually showing you how to automate what we're showing you here today with options play. Because at the end of the day, most of us don't have a lot of time every single day to stare at all the option chains and go through pages and pages of them, searching for the cover calls and cash secured puts manually, and then calculating yields and then executing those trades. In reality, most of us are very short on time. So what I want to do is show you how options play makes the process for researching what we're showing you here today down from a few minutes down to just a few seconds, so that you can instantly make a decision on any stock or ETF that you own, instantly where to start selling cover calls on it. And then lastly, what we'll do is we'll wrap this up by talking about the exit strategy. So once you're in a cover call, how do you actually manage those calls? So those are some of the things that I want to cover here today. So let's go ahead and get started. First, I want to cover what is a cover call. A cover call is actually a very simple strategy that I think pretty much anyone that has an equity account should be able to understand. What we're doing is we're taking existing positions that you have in your equities account, and this is only available for positions that you have at least 100 shares of, because each call contract represents 100 shares. You can only sell a cover call on a position that you own at least 100 shares of. So any stock position you have that you have 100 shares of, what you're going to do is you're going to sell a call option against it for income, and the combination of the long stock and the short call that you've sold is what we call a cover call. So next, what I want to talk about is why should we sell a cover call, and what does this actually mean for your portfolio? So in order to convey this message, I want to think of this in a different way. I want to think about an existing option, an existing equities position that you have, and I want to think about, what is the alternative to selling a cover call. So here I have an example. Pretend for 1 second that you own 100 shares of Apple and it's currently trading, or you have it at a cost basis of $170. This could have been a stock that you purchased today. It could have been a stock that you purchased a year ago. Regardless, you have 100 shares of Apple. And think about the fact that if you own Apple, why do you own Apple? You own it because you think the stock's going to rise in the future. So most times, or in most cases, when you buy a stock at 170, you may have a target price in mind as far as where you think will go. And traditionally, if you weren't an options trader, if you bought the stock at 170 and you think you have a target price of 185, how do you actually take advantage of that? You would simply place a limit order to sell your stock at 185. This is the comparable strategy to selling a cover call. Is you buy a stock, you think it's going to rise, so you place a limit order at the target price you think it will rise to. So, and as an alternative to that, what we're suggesting is instead of just placing a limit order at the price target that you expect the stock to reach, what you do is you sell a cover call at that same point. So here what I have is an example of selling an April 185 cover call. So the same strike as the limit order that I would enter, 185, but instead of just placing a limit order, I'm going to sell a 185 cover call. And let's say for that I receive a $3 income or $3 premium for selling that cover call. So what I want to do is I want to compare these two scenarios and see what your outcomes are to show you why you should consider selling cover calls on a lot more stocks than you probably currently sell calls on. So number one, let's talk about what is the risk of each strategy. I think this is the part that is on everyone's mind, is how much risk do I have if I'm selling a cover call? And the answer is you're going to have less risk than if you simply bought the stock and placed a limit order. Because if you buy the stock at 170 and you place a limit order at 185, your risk is $170 a share. On a cover call, your risk is actually the $170 a share minus the $3 that you received on selling that cover call. So your total risk is actually only $167. So right off the bat, by selling a cover call, you've immediately reduced the risk of your portfolio by selling a cover call. And now no matter what happens to your position, you immediately realize less risk on your portfolio. And this is a key part of utilizing options, not just to generate income, but also lower the volatility and lower the risk of all of your entire portfolio. portfolio. And as you continuously do this, you're actually going to continuously further reduce the risk of your entire portfolio. And this is one of the key reasons why selling cover calls helps you outperform over the long run, because not only are you generating income, which will help outperform, but you're reducing your risk, which is another aspect of helping you outperform the market. Now let's take a look at reward. What happens if the stock rises? So we said that we bought the stock at 170. We think it'll rise to 185. Let's say the stock does rise up to 185, or maybe if it even goes all the way up to 190. What happens? So when you place a limit order at 185, if the stock rises by $15, your gain is $15 a share. That's how much you can make. The difference between 185 and 170, that's how much you make. If you sold the cover call, your gains are now 185 minus the 167 cost basis that you have. So instead of making just $15, you're now making $18 a share. So not only have you reduced your risk on the overall trade by selling the cover call from 170 down to 167, you've also improved your returns if the stock does rise. So from $15 return to an $18 return. And this strategy is now profitable as long as the stock stays above 167, because your new cost basis, your new adjusted cost basis on the stock's 167, even if the stock drops by a couple of bucks, you'll actually still net a profit on this particular trade, which is not true if you simply just buy the stock at 170 and it drops $2, you lose $2 a share on that particular trade. So all of these three scenarios, you come out ahead when you sell a cover call, as opposed to outright just buying the stock and placing the limit order. And that's, again, truly a comparison you should be making or thinking about when you sell a cover call. And lastly, in terms of time, and this is really, in my opinion, one of the best things about selling cover calls, is that when you buy a stock at 170, you basically maintain exposure until Apple rises to your limit price, because you will continuously maintain exposure to that stock until your limit order is executed. However, here, your exposure is only until the expiration date, meaning you can collect $3 between now and April. And if the stock doesn't rise to 185 by April, you can sell another cover call for another $3 and reduce your risk from 167 maybe down to 165 or 164. And you can continuously do this until your stock does get called away. And perhaps by that time, you've maybe generated $5, $10 in income before the stock gets called away. So now, on top of the $15 that you might realize on the stock rising in appreciation, you might have gained another $5 or $10 in income. And this is the income stream that you're going to try to build across all of the stocks in your portfolio, not just a single stock. And this is really what I'm hoping to show you guys here today, is how to utilize this strategy to, number one, build an income stream off of the stocks that you own, similar to, think of it like a dividend that you get paid every single time the call gets expired. And when your stock does get called away, you're effectively selling your stock at a limit price that you're comfortable with, essentially taking profits on the stock that you own, because you own those stocks because you think it'll rise in value. And when it does rise in value, you want to be able to take profits. And cover calls is a way to allow you to not only take profits on the stocks that you own, but more importantly, generate an income stream off of those stocks as you hold on to them, waiting for it to appreciate in capital. So why should you use cover calls? We went over a lot of different scenarios and why, in my opinion, cover calls outweighs outright placing a limit order. But the key benefits for selling a cover call, number one, is to exit your stock at a profit while generating income. So it's allowing you to place an order to sell your stock at a profit, but also at the same time generate an income stream from that you don't get if you simply place a limit order. Next, it lowers the volatility and the net cost basis of your stock, because, as I showed you before in the last example, by lowering your net cost basis, you're reducing your risk, which lowers the volatility of your portfolio, and you're reducing your cost basis, which increases your returns when the stock does rise and your stock gets called away. Lastly, and in my opinion, this is the best part, is the fact that it's simply used on the existing stocks that you already have in your portfolio. And just to clarify, this is not a strategy that you should necessarily go out, buy 100 shares just to sell a cover call, because that's not really what a cover call is for. Cover calls are for the existing stocks in your account that you already own, and to be able to generate additional yield on those stocks. That's the goal of selling covered calls. I want to make that clear. I don't recommend you to go out and buy stocks just to sell a covered call, because the yield that you get on a covered call simply does not outweigh the risk of the stock going down. So that's why, generally speaking, with these types of strategies, it's only for the stocks that you already own in your account. Now, this strategy does have a few limitations. Number one, when you sell a cover call, you're limiting the upside return of your stock. But that's exactly the same thing you're doing when you place a limit order. When you place that limit order at 185, you're basically saying, even if the stock rises to 1,000, I'm getting out at 185. So when you sell a cover call at 185, you're effectively doing the same thing. You're limiting the return of your stock beyond the strike price that you've sold. This strategy does require at least 100 shares. So if you have stock that you only have 50 shares of, this is not a strategy that you should trade. This is not a strategy that you can trade a cover call on. You need at least 100 shares. And lastly, you risk selling your stock at the strike price that you've selected. So this is really why we want to be careful with where we select our strike prices. And that's some of the things we're going to cover in the next few slides. So when you're selling cover calls, there's really only two things that you need to decide. You need to decide an expiration date, and you need to decide a strike price. So let's first talk about expiration dates. How do you actually go about selecting them? Now, in my opinion, when you're selecting expiration dates, this really comes down to how often you trade. Now, you may have different views as to which expiration dates are suitable for you, but I generally find that you want to trade an expiration date that suits the frequency of which you trade your account. So for those of you that are active traders like myself, you have time to look at your account pretty much every day. You want to sell relatively short-dated options. So any short-term options from 21 to 49 days out is usually suitable. This is about 3 to 7 weeks out. That's usually the sweet spot with respect to weekly options. That's where we see the liquidity. That's where we're going to be able to get the most yield from, I'll come back to getting the most yield, but this is really where you're going to be able to really maximize the theta of an option, is in those short-term options. On the other end of the spectrum, for those of you that are long-term buy and hold investors, if you buy stocks and you hang on to them for a few quarters or maybe even a few years at a time, you want to sell longer dated options, 90 to 100 days out, so 3 to 6 months out. You don't necessarily look at your portfolio every single week or maybe even every single month. You don't necessarily want to sell short dated calls. You only want to sell calls that you can manage, which may expire every few months or so. And lastly, most of you will probably be somewhere in between that. So if you do find yourself to be more of a casual investor, you look at your account once every few weeks, that's really where we think that the medium-term option, so anywhere from 50 to 89 days out, so about a month and a half to about 3 months out, is the sweet spot that you want to be in with respect to expiration dates. Now, what I want to look at is, what do you actually get between, or what is the difference between selecting short, medium, and long-dated options? So number one, when you select a short-dated option, what you're effectively doing is you have when you sell an option that expired just in a few weeks, you have a fair amount of certainty or visibility into what's going to happen between now and the expiration date. So things like earnings announcements, dividends that are about to come up, perhaps even things like product launches are probably visible within a few weeks time frame. So you have, generally speaking, a much clearer sense as to what may happen between now and expiration. So this is where you're going to have a lot more certainty as to what's going to happen. And in exchange for that, what you're going to get is a lot less income from selling a short-dated call. Conversely, on the long end of the spectrum, if you're selling 3, 4, 5 month options, you have a lot less certainty as to what's going to happen between now and then. So things like even the next earnings date, you may not even know when the next earnings date is or when the next dividend is going to come out. You know, a lot of things can happen in 4, 5, 6 months. So you have a lot less certainty. In exchange for that, you're going to get a lot more income. So when you sell long dated options, you're going to get more income. When you sell short dated options, you're going to get less income. So what we did is we back tested all the different expiration dates to see where do you actually get the highest yield in the long run. And the answer is on the shorter end of the spectrum. And why is that? The answer actually comes in places that are not exactly obvious. Number one, what we found is that it's better to sell short-dated options because we found that it's better to avoid selling covered calls during earnings. Now, when you sell short dated calls, you can avoid those earnings cycles. So if you're selling calls that expire 1 month out, you can do that 12 times a year, which means that only a quarter of the cover calls that you sell have this large uncertainty factor built into it. Cover call earnings, 4 out of the 12 calls have this earnings cycle built into it. So only a quarter of those calls that you sell have this earnings announcement within that expiration cycle. If, on the other hand, you're selling 3-month options, then that means that every single cover call that you sell has an earnings announcement built into it. So 100% of the cover calls you sell have this large uncertainty factor built into it. And earnings is really the one thing that we see is the largest detrimental aspect to selling covered calls. So we generally find that it's better to avoid selling cover calls during earnings, and the best way to do that is by selling shorter dated calls, because I can actually skip the 4 months out of the year where there's an earnings coming up and still sell cover calls the rest of the 8 months. And that's really what allows me to generate at maximum yield throughout the year. The other thing that we looked at that wasn't abundantly obvious when you first look at cover calls is that the premium that you receive with a cover call is not linear to time, which means that if you sell a 1-month call and you collect $1, you're not actually going to collect $3 by selling a 3-month call, which you would expect to do that. But in reality, what we tend to find is when you go out 3 times this amount of time, you're only going to get about 2 times the amount of premium. So if you're collecting $1 on a 1-month call, you're likely only going to collect $2 on a 3-month call. So even though you're gone out 3 times as much in time, you're not getting paid 3 times as much. So that's why, again, it's better to sell 1-month calls, because you can actually do that twice in a row, skip the 3rd month, and still collect roughly the same amount of income as someone who sold a single 3-month call. And that gives you the ability to skip the months where there's an earnings cycle coming up. And that's key to successful trading in terms of selling cover calls. So that's what we generally find when we're trying to figure out what is the optimal expiration date to sell when it comes to cover calls. And actually, in reality, what we're showing you here is not necessarily limited to just cover calls. The same applies to selling puts, selling credit spreads for those of you that do trade some of those more advanced strategies. What we're teaching here really applies to all of these strategies. Next, what I want to explore is selecting a strike price. So we talked about Apple trading at 170. You may have a target price of 185. Maybe someone else has a target price of 180 or 190 or 200. Everyone may have a different view as to where they think the stock will go. So how do you actually go about selecting the appropriate strike price? Number one, what I have here is 3 different buckets, because we tend to find that when you're selecting your strike prices, they should really be based on your risk tolerance, meaning how far do you think the stock will go before you want to take profit on the stock. So for someone that's conservative, meaning someone who doesn't really want to lose their stock, maybe you hang on to the stock because you need it for dividends. You want to make sure you have a large chance of holding that stock. You would fall under the conservative end of the spectrum. For someone who's really trying to chase as much yield as possible, you would fall under the aggressive end of the spectrum. And then most of you, like myself, will probably fall somewhere in between, or what I call optimal, meaning you're not too conservative, meaning you're not necessarily needing to hang on all your stocks and you don't want to sell it, but you're also not necessarily chasing as much yield as possible. You're trying to find a nice balance between the two. That's where you want to select the optimal track. And depending on which one you select, that's really where we just help you figure out what is the appropriate strike price. Now, we tend to find that using Delta is a good way to select your strike prices, because Delta automatically adjusts for changes in volatility. So Apple is a relatively low volatility stock. So what we use is probability to determine what is the strike price that has a 70, 80, or 90% chance that the stock will not hit those prices, because that's how we go about selecting the appropriate strike prices. So if you're conservative, you want to select roughly about a 10 delta call. So a call that has about a 90% chance that it's going to expire worthless and you're going to be able to keep that premium, and only a 10% chance that your stock gets called away or gets taken away from you. On an optimal track, you want to select roughly a 20 delta call. So a stock that has a strike price that has roughly about an 80% chance that that call will expire worthless. And then for those of you that are more in the aggressive end of the spectrum, a 30 delta, about a 70% chance that the call that you sell will expire worthless. So what are the differences between the strikes? So a conservative strike obviously is a strike that's very, very far above the current price. So a very high strike, what that gives you is more upside for your stock to grow before the stock gets called away. And in exchange for that, what you're going to get is less income. So the higher the strike that you sell, the less income you're going to receive. On the other flip side, when you sell an aggressive strike, these are strikes that are relatively lower. These are strikes that are much closer to the current price of Apple. This is going to give your Apple stock a lot less upside before the stock gets called away. So imagine placing a limit order very close to the current price. That's what selling an aggressive cover call is like. And in exchange for that, you're going to get more income for that. So again, what we wanted to do is we wanted to test out all these different strike prices, backtest them over the last 10 years and see where do you actually get the highest return. And again, what we found surprised us a little. We actually found that you have to be on the more conservative end of the spectrum to get higher returns. And the reason for this is because of the fact that cover calls is a strategy that we consider to have negative risk to reward. What that means is that the reward that you can receive from a cover call is limited to the premium that you receive on the cover call. So if you sell a call for $1, no matter what happens, you cannot make more than $1 on that trade. So the reward you have is limited. However, the lost opportunity that you have here is unlimited. So what do I mean by lost opportunity? If you have Apple stock at 170, and you sell the 185 strike on Apple stock, and the stock, for whatever reason, it may be on earnings, maybe on news, shoots up to 250, magically overnight, right? So now what happens is that you've lost out on that opportunity above 185, and the amount that you can lose out on is unlimited. There's no limit to how much money you can lose out on, and that obviously is not a loss to you, but it certainly hurts to take profit at 185 when you could have taken profit at 220 or 230 or 250. So that lost opportunity is unlimited, and we factor that in as a loss, even though it's not a true loss to you, because it is going to underperform your portfolio if you do sell a cover call. So that's why what we found with the strategy is that you do want to sell relatively far out of the money calls, really reduce the opportunity of having too large of a lost opportunity, and giving your stock upside room to grow before the stock gets called away. And the reason for this is because you own the stock because you think it's going to appreciate. Let your stock appreciate before it gets called away. If you cap that appreciation too low, you're going to underperform what you really want in your portfolio. So don't just chase the fat yields that you get by selling relatively close to the money cover calls, unless you really want to get out of the stock. But even if that's the case, you might want to edge your strikes a little further up than where you might actually want to be. So what we've found is that stock upside is much more important than big premiums in the long run for generating the most yield for your portfolio. So with that in mind, lastly, what I want to talk about is once you've followed this methodology, once you select the appropriate expiration date, once you select the strike prices based on this methodology, let's say you do that and you pull up the option chain and you find, the 30-day option, you find the 20 delta call, and let's say it's trading at 5 cents or 10 cents or 50 cents or $5. How do you know, are you getting enough income for this? Because it matters whether you're doing this on a $5 stock or a $500 stock or a $10,000 stock. How do you know if you're getting enough income? And the answer to this is actually quite simple. What you want to do is you want to compare the cover call yield to the dividend yield. And for those of you that are asking, how do I know what the cover call yield is? That's something that OptionsPlay actually calculates for you. It's just the yield that you'll actually receive on the cover call. And what you generally want to do is you want to beat the dividend yield with the cover call that you're receiving. So in a few different examples here that I have, if you have a cover call that you're looking at that yields a 3% yield on a stock that pays you currently a 1% dividend, that's the type of situation that you're looking for. You want to increase your yield beyond what you're currently already getting in your dividend. In a second example, if you sold a covered call on a stock that yields a 3% dividend yield and you're getting 3% on the covered call, that's the bare minimum that you're really looking for to take on the risk of losing the stock at a certain price. And lastly, if you have an example where you're looking at a covered call that only yields you 1% on a stock that already pays you a 3% dividend, what that's saying is that you're just not getting enough additional yield to take on this risk of losing the stock prematurely. So that's how you want to go about selecting your expiration date and strike price, and then determining, am I actually getting enough yield? You don't want to just go based off a dollar amount, because the dollar amount will change based on the underlying price. So this is why yields are the best way to actually measure, are you getting enough income? So before we jump over to options play, I just want to summarize a few trading tips for selling covered calls. Number one, the most important thing is that you want to start selling covered calls immediately after you acquire your shares. You don't want to wait, because if you wait, chances are, what I hear from a lot of clients is, I bought the stock at 170, it's now down to 140 or 130. Should I start selling covered calls now because I want to try to make some of my money back? You certainly can, but at that point, when you're down that much, it's a little too late, because the yields that you're getting are 2, 3, 4, 5%. That's not going to overcome the 30% that you've lost on the stock, even in a good year. So that's why this is something that you need to start immediately once you acquire a stock. You want to sell relatively short-dated options to maximize your yield. So usually about 3 to 7 weeks out is the sweet spot for selling weekly options for covered calls. You want to sell strikes with relatively low probabilities of assignment. So these are strikes that are usually relatively far away from the current price, with about a 15 to 20% chance that your stock will get called away. You generally want to avoid selling covered calls going into earnings. So if you have an earnings announcement coming up, this is not an ideal time to sell covered calls. You want to sell them after that earnings announcement comes out. And lastly, what I want to do is I want to cover exit strategies. But before I do that, I want to jump over to options play and actually show you how we automate these strategies and what we just showed you here today, so that not only do you have to not remember everything I showed you, but we want to help automate as much of that as possible to save you as much time as possible from researching any of these strategies. So for those of you that are brand new to options play, welcome. The platform itself that we're going to show you here, again, you can have access to a free trial at optionsplay.com. The platform itself is divided into 3 sections. You have trade ideas and watch lists on the left-hand side. You have our security analysis panel here in the middle, and we have trading and income here on the right-hand side. We call these 3 panels the what, the why, and the how of options trading. And this tool was designed from the ground up to make the user experience of options trading as simple as possible and helping you avoid having to look at option chains every single time you want to sell a covered call. So today what we're going to do is we're going to focus our time on the income stream. The income screen, which is really where we want to spend our time today, because today we're here to talk about how to generate income by selling covered calls. So before you do anything on options play with respect to income, I want everyone to use the income settings button at the bottom of your screen. This is where you're going to set your time frame and your risk tolerance, and that's what drives options play to find all of the relevant cover calls and cash secured puts based on your settings. So we talked about, for time frame, selecting either short, medium, or long-term cover calls. So like I said, I'm fairly active, so I always choose short-term, and this is also where we find the maximum yield from this type of strategy. And as far as risk tolerance goes, conservative, optimal, or aggressive, I tend to find myself to be more in the optimal camp. I'm not too conservative, I'm not too aggressive, so I choose optimal. And what this allows you to do is set them independently of each other. You can sell calls separately, and you can sell puts separately as well. So if you like to sell cash secured puts like I do, I like to chase more aggressive cash secured puts. We have a whole separate webinar just on that one topic alone, but this allows you to set them independently of each other. And once you click on Save as Default, what I want to do is I want to pull up a watch list first. So for those of you that sell cover calls, I highly recommend you to set up a watch list with all the stocks that you own, because then you're going to be able to just simply click on a stock that you own and instantly, within a few seconds, know exactly where to start with selling covered calls. So Lockheed Martin's at $299.01. And what this immediately tells me is that if I own shares of Lockheed Martin, which I'm selling covered calls on, I would, if I click on yes, it'll tell me to start looking at the April 12th 310 covered calls. So this is a call that expires in 22 days, so roughly about 3 weeks out. It's the strike price is 310, so which is right around this resistance right here, the 52-week high around 310. And what this is a cover call that's effectively $11 above the current price. And as you can see, what this tool provides me with is not only the starting point for the expiration date and strike price, but it also gives me important information like the yield. So the yield on this cover call is 6.1%. And Lockheed Martin pays a 2.97% dividend yield. So this is a stock that already yields a nice 3% yield. I'm going to be able to add an additional 6% on top of that by selling covered calls, which brings my total yield to 9%. This is the type of yield impact that you should be comfortable with seeing when you add covered calls to your portfolio. So think about the dividend yield you have in your portfolio. Most portfolios yield anywhere from 1 to 3%. Here you're going from 1 to 3% to roughly 9-10%. And this is the income stream that usually people want to use when they're selling covered calls. And what I want to do is I want to compare that to looking at an option chain, because if you're looking at let's say an option chain on a stock, and let's say in this particular case, this Lockheed Martin example, it takes quite a bit of time to go through an option chain and figure out where you want to start. Let me see if I can pull up an options chain for you. Let's see. So here's an option chain. Let's say I'm looking at Lockheed Martin. As you can see, I can spend a lot of time scrolling through all the different expiration dates and all the different strike prices to try to figure out where is my ideal starting point. And for any of you that have traded options before, this is what you're used to as your starting point. Meaning you have to scroll through pages to figure out what is the right expiration date. Then you have to go through all the strikes to calculate, okay, which delta do I want, and find the delta that meets your criteria. So let's say you do all that work and you manage to find the 310 strike on the April 12th. Now you see that it's trading at $1.10 by $1.80. How do you know if that's enough yield? Chances are you don't. You have to manually then calculate what's $1.10 in terms of yield, and then go back and compare that to the dividend yield. That's a lot of work. What we do here at Options Play is all you have to do is simply click on a button for the stock that you own, and we instantly tell you, number one, the expiration date and strike price. So Tesla is trading at 274.02 right now. This is telling me to look at the April 12th 307.5 cover call. So this is a stock that's roughly $25, $27 above the current price. That expires in 22 days. And as you can see, if you own Tesla, you get paid $0 in dividends. On a cover call for Tesla, you get paid 22% yield. So think about the stocks in your portfolio. Even if you only focus on the stocks that don't pay you a dividend, these are the types of yields that you can start increasing for your portfolio by adding a cover call to it. And we do it for you instantly so that you don't have to pull up an option chain, search for the strategies, search for the expiration date, strike price, and then calculate yields yourself. This does all of that work for you. And you can simply click on any symbol and within a few seconds know exactly where to start. Amgen's trading at 191. This is telling me to look at the April 12th 202.5 cover calls. These are steps that you normally have to do manually looking at an option chain. We've automated this whole process to make this process as simple as possible so that not only do you see all the information that you need to make a quick decision and click on trade and enter this trade into your broker's platform, more importantly, what this allows you to do is go down a list of stocks within a few minutes. You can go through a list of 20, 30, 40 stocks and know exactly which stocks you have opportunities to generate income on. So Apple's at 195. This is telling me to look at the April 12th 207.5 cover calls, which yields me an 8% yield on a stock that pays only a 1.5% dividend yield. So I'm quadrupling my dividend yield by adding this type of cover call to my Apple position. These are the types of stocks that you want to look at for selling cover calls. And what I want to show you more importantly, actually, is that sometimes you pull up a cover call, you pull up a chain, you want to try to find a cover call, and you spend a few minutes going through all the expiration dates and all the strike prices, and then you realize, well, there's just not enough premium in this stock, or maybe there's not enough strikes to find the optimal cover call. So let's go look at Ford. As you can see, on a Ford 1 month option, even if I go out to April, Ford's trading at roughly $8.69. The $9 strike only has 10 cents in premium, and that's only a few cents out of the money. And if I go to the 9.5, there's only 3 cents. So I've spent all this time to go through the option chains just to find out there's not enough premium in that. If you're on options play instead and you click on Ford, what we do is we instantly tell you, hey, based on the currently available options, options play did not find an optimal call to write on Ford. And what this does is it saves you a lot of time, because now you don't have to spend time looking for a cover call on Ford. You know that it's time to simply move on. And this allows you to click on any strategy or any symbol, stock or ETF, and instantly be able to see exactly where your starting points are for each one of these strategies. So here, Bank of New York, 51.89. This is telling me to sell the April 12th 54 cover calls, yielding me 7.3% return on a stock that pays a 2% dividend, giving me a total return of 9.5%. So I'm tripling my yield on this particular trade by selling cover calls on my Bank of New York position. Coca-Cola, 45.51, telling me, oh, this, as you can see, again, saving me time to tell me that I could not find an optimal cover call on Coca-Cola. It's telling me the next best alternative, which in this case is a short-term aggressive cover call. So maybe this is outside of my realm of what I'm comfortable with because I prefer optimal strikes. This is giving me an aggressive strike. So this is, again, telling me to move on, not trying to waste my time trying to search for optimal cover calls on Coca-Cola. And especially when something doesn't exist, this is where we see a lot of clients force the issue, meaning they don't quite find what they're looking for, so they find the next best thing. Next thing you know, you're trading something that you didn't want to trade to begin with. This is not only designed to help you find the right starting points, but more importantly, avoid bad ones. So I can move on immediately to the next one. So Johnson & Johnson trading at 138.10. Telling me to look at the April 12th 142 cover calls. So Johnson & Johnson's at 138. This is telling me a 4% dividend, a 4% annualized return on a stock that pays a 2.6% dividend yield. So not as attractive as the other ones, and this is a pharmaceutical stock that doesn't move a lot. So the yield on this is not very high, but I'm still increasing my yield from 2.5% to 4%. So this is really the type of strategies that I want to look for. Sprint, I bet I'm not probably going to be able to find one on Sprint. Yep, so here on Sprint at $6, a lot of the low price stocks, it's hard to find a cover call on. So this is going all the way out to August before it's able to find me something. So again, way outside of the realm of what I would normally trade, so I would immediately move on. So as you can see how easy it is for me to go through a list of stocks and without any effort be able to instantly see where my starting points are for any of these stocks instantly when I click on any of these specific strategies. So American Express, 111.82, telling me to look at, in this particular case, let's see here, looks like my internet's a little slow here today. Let's see if I can find a better one here. Walmart's trading at 99.06. Let's see if this will load. If not, I'll come back to this. It looks like my internet's a little slow here. I'm going to come back to this. In the meantime, what I want to do is I want to talk about exit strategies. So, I spent a lot of time showing you guys how easy it is to get into a cover call, but once you're in that cover call, how do you actually manage it? We get a lot of questions regarding this. And this is really where the rules are actually, even though sometimes confusing, they're actually quite easy to understand. So when you sell a cover call, there's really three scenarios that you'll come across. Number one, the stock shoots higher. Number two, the stock trades sideways. And the third scenario, the stock drops. And in each one of these scenarios, it's pretty clear as to exactly what to do. And if you memorize this, it will really help you take the emotion out of the trade, because I tend to find that a lot of cover call traders tend to get a little caught up in terms of what happens between now and expiration. But in reality, there's really, most scenarios, you don't really have to do much. So number one, when the stock rises, this is where I see a lot of users tend to panic because they see this unrealized loss on their short call that they have, and they're not sure what to do. Keep in mind that whatever losses that you have in the short call is offset by the long stock. So you're not actually having any true losses. And a lot of users will say, should I get out of the trade? And the answer is no. Don't panic. Hold on to the cover call and roll it only in the last week before expiration. And for those of you that are asking, what is a roll is very simple. You're buying back the call that you've sold and you're selling a new cover call. And that process of doing it all into one single trade is what we call a roll. The only caveat to this, or the only exception to this rule we tend to see, is if the stock really shoots up. So that 20 delta call that you've sold is now a 90 delta call. This really means the stock took a very, very large jump of, higher. That's the only time where we do think that it makes sense to simply buy back the call and simply sell your stock at a profit so that you're able to get out of the trade. Effectively, you're basically taking profit on the stock that you own. In the second scenario, when the stock trades sideways, this is your best case scenario when you sell a cover call, because whatever premium you receive from selling that cover call, you keep all of it and you can do it all over again. So you're the stock that you bought, you haven't really gained or lost much on it, but you've collected the $3-4 maybe on that cover call, and you get to do it all over again. And this is where you start building an income stream on the portfolio that you own. And in the last case, if you sell a cover call and the stock drops, this is really the only time where it makes sense to buy back a cover call or roll your cover call early, meaning well before expiration. If the stock drops, chances are you might have sold a call for $1 and maybe it's trading now at only 10 cents or 5 cents. So you've effectively made a 90 or 95 cent profit. You buy back the call, you collect that 95 or 95 cent profit, and you sell another cover call. So now you've made 90 cents, you can sell another call for another $1 and continuously, again, to add yield to your portfolio. So, and the rule of thumb here, as far as when do you buy back that call early, if you can buy it back at 20% of the original premium that you sold it for, that's usually a good point to consider rolling your position early. So if you sold something for $1, you can buy it back for 20 cents or less. That's when it's time to roll your cover calls early. So those are the three scenarios you'll find yourself in when you sell a cover call, and how to cover each one. So with that, what I want to do is I just want to go back to options play. That in itself is what I wanted to show you guys here today. So I do want to thank everyone for taking the time out this afternoon and listening to us talk about this very important strategy, because again, this is really a strategy for everyone to consider, regardless of whether you're an equity investor that's never traded options or if you're an experienced options trader. This is a strategy that all of you should be utilizing. As long as you have stocks in your account, cover calls is a way to add additional yield to your portfolio. So with that, what I'm going to do is I'm going to open this up for Q&A. If you have any questions regarding anything I just explained here before, please type them into the chat window or the Q&A window, and I will answer as many questions as I have time for. And again, this webinar is recorded, so in about half an hour after we finish here today, I'll send everyone the recording as well as the slides so that you can follow along as you watch the recording afterwards. So please, again, if you have any questions, type them into the chat window or the Q&A window, and I'll answer as many as I have time for. So it looks like there's a few questions already. What does POW mean? POW here on the income tab. This is really the probability of expiring worthless. So we talked about delta. Delta tells you the probability of the stock hitting that strike price. So the POW tells you what is the probability that you actually keep the premium that you sold. So in this particular example, Walmart's at $99. If I sell the 102 cover calls, there's a 78% chance that Walmart will not go to 102 or higher, which means that there's a 78% chance that I'm going to keep the $34 premium that I collect on this cover call. That's what POW refers to. There's a question. I understand the difference in delta, but would like to know the word behind the acronym POW. Oh, okay, same question. So again, POW refers to probability of expiring worthless. Paul saying, I don't see an income settings on my account. Paul, if you don't mind sending me an email at info@optionsplay.com, I'll be happy to take a look at your account and see why you don't have that setting on your account. Roger saying, if implied volatility is low when you are assigned or buy to close a cover call, should you wait until IV rises again to sell another call? No. So generally speaking, IV is not something you need to account for when you're selling cover calls, because delta is already adjusting for implied volatility. So if implied volatility is really high, delta will automatically select a strike price that's further away. If implied volatility is very low, delta will automatically select a price that's relatively close to you. So you don't have to think about implied volatility when you're selling cover calls. Great question though, Roger. Frank is saying, why should I choose a stock which is in downtrend like Lockheed Martin? So again, this is not telling you to go and buy the stock just to sell a cover call. This is for stocks that you already own. So I'm not saying that you own Lockheed Martin. You put in whatever stocks that you already own in your portfolio and sell cover calls on those stocks. I'm not suggesting at all that you go out and buy Lockheed Martin just to sell cover calls. So Frank had a second question here. I wouldn't own stocks like Amazon because it's too high of a price. So as an alternative, and I think Amazon's a good example here. I don't think not many people have the money to place a $181,000 trade on Amazon. So what can you do? Amazon is a great example of this. Instead, what you might want to do is perhaps you want exposure to Amazon. What you can do is you can simply buy a leap option. You can buy a deep in the money leap option, and you can sell calls against that leap option the same way you do with the stock. So here, if let's say instead I'm looking at buying maybe a September, let's say 117.50 a call option, instead of costing me $182,000, this only cost me $19,000. Similar risk profile to owning the stock. But what I can do is I can still continue to sell cover calls against it. So even though this cost me, roughly 20 grand, I'm going to collect $1,100 by selling the April 1910 cover calls against it. So I can start offsetting the cost of my long call by selling cover calls against it. So if you don't have 100 shares, you can also buy a call option and sell calls against that call option. You don't have to only do it on stocks. Michael saying, I've had stocks I did not want to lose assigned 2 weeks prior to expiration. Do you see rolling to a diagonal with a credit as an option? I'm not sure what you mean by rolling to a diagonal. You do place a diagonal to do the roll. Michael, if you don't mind elaborating on that, I'm happy to answer that question. Tapas, thank you. Don, when selling cover calls, do you ever buy put to protect the downside? You certainly can, and that's what we call a collar strategy. So, for example, here, if I modify this, or actually I'll modify this one to put on a collar, you can certainly place a collar on any stock. So let's say you want to buy a downside put and then you want to sell an upside call. You can certainly do that. That's certainly one way to do it. However, when you place a collar, chances are what you've done is you're going to pay more for that put than you're actually going to receive in credit to sell that call. So a collar is really useful when you expect a downside move, but you wouldn't want to put on a collar all the time because you've effectively then just paid what you've received in premium on that put. Arnold, NGVT. I'm not sure what you mean by that. If you can elaborate, I'm happy to take a look. How do you edit stocks in the watch list? So great question. You click, so you simply click on menu. You can click on edit watch list. You can delete, you can move them, or by adding, you can just simply type in a stock to add them. So it's really easy to add or remove by clicking on edit watch list. Are you going to be discussing cover calls with leaps, poor man's cover call? Yeah, I think I just covered that real quick with Amazon, right? So, again, you can buy, instead of a $182,000 to buy 100 shares, you can buy a leap option. Or not even a leap option, you can buy any call option rather and sell cover calls against it. So here, buying a September 1750 call cost me 19 grand as opposed to 182 grand, and I can sell calls against this long call as opposed to that long stock. And again, that's what we call a poor man's cover call, because you don't have enough money to buy 100 shares, you might have enough money to buy a call option. Where can I find butterfly and condor strategies in options play? Everything is in our strategy constructor. You can select any strategy to put on a butterfly, calendar, condor, or any of the 45 plus strategies that we have here at Options Play. What are the scores next to the bullish, bearish, neutral arrow? They are related to each other somehow or nothing to do with each other. I'm not sure which the score next to the bullish, bearish, neutral arrow. If you're referring to the score here in your watch list, the score is the technical score. This is a relative strength ranking that we have. We actually have a whole webinar just on how to gain a directional edge using our proprietary trend and relative strength indicators. Relative strength basically measures the stock against all other stocks in the market to tell you if it's outperforming or underperforming. So it's on a score of 1 to 10. 10 are the strongest stocks in the market, 1 are the weakest stocks in the market. Kush is asking, when a stock plunges and I buy back my call that I sold, when it was trading higher? Now, if I sell cover calls again, it means that I may be selling my equity at a loss when it gets called away. That's correct. You're absolutely right, Kush. And that's why, again, which is why we always advocate to start selling calls as soon as you buy that stock, which minimizes your risk of doing that. And you always want to sell relatively far out of the money calls. So even the stock plunges, chances are it doesn't plunge that, hopefully it doesn't plunge that much where the very second call you sell is below your cost basis. Because most of the time you're going to be selling calls that are, 10, almost maybe 10% out of the money. And that means that you would have to have a 10% plunge in the first month for that situation to happen. And, that doesn't happen very often, generally speaking. Can I check any stock, or is there a predetermined list on Options Play? You can type in any stock in the world. Any stock or ETF, you can type in and look at Options Play. Every single optionable stock, ETF, or index, you can enter into Options Play. Someone just asked about the technical score. That's the question I just answered. Mitch is asking, is it possible to determine unusual heavy options activity with your tool? So that's not something we currently offer, but that's because there are a lot of services that are already offering that. You can go on Twitter or StockTwits or subscribe to some of the premium feeds that do some of that stuff. It's not what we do. I don't necessarily follow options volume per se. There are lots of people that do, but that's not really something that we do here. If the proceeds of selling a call is so small, what would that be charged with a brokerage fee, say less than $1? So number one, you would never sell a cover call for less than $1. But all the fees that we're showing you is exclusive of your commission. So if you sell this cover call for 80 cents or $80 rather, and you pay a $10 commission, then your proceeds are only $70. So it is something to consider, and this is why, and I will say that, options commissions have come down substantially in the last few years as the major brokerage firms have really competed with each other on price, which is really a good thing for investors. And most of the major brokerage firms, they've slashed the ticket price, they've slashed the per contract price, and this is really bringing down the cost of trading. And there are even quite a few firms now that offer commission-free or very close to free options trading commission. So if you have a small account, you're very sensitive, you might want to take a look at some of the brokerage firms that offer low commissions. Before buying a stock, would you sell a naked put first and wait to be exercised? So that's a great question, and this is a question that I cover heavily in our webinar just on selling cash secured puts, which is selling a naked put is one of my favorite strategies to buy a stock because it does effectively the opposite of what I'm showing you here. Instead of buying a stock and placing a limit order to get out, selling a put is like placing a limit order to buy your stock. So instead of just placing a limit order, you sell a put and you actually get paid to do so. So yes, to answer your question, absolutely. I advocate very heavily for those of you that buy stocks to consider, instead of placing a limit order, sell a put. You're going to get paid for it. And if the stock drops to your price, you effectively are buying your stocks at a discount. Very, very popular strategy amongst traders that are looking to dollar cost average into their stocks. Frank is asking, when the stock goes down, you make money on the call, but you lose money. When you sell, then a new call and called away, have a loss overall. I think I just covered that question with another one. Ed's asking, Apple, example of a stock that has moved 22 points in 2 weeks. If I sold calls, just wait until the week of expiration to make a decision? Absolutely. So the reason for this is because if you do something early, let's say you have still 2 weeks left on that call. Perhaps Apple comes back down another 10 points in the next 2 weeks. If you did something early, you might have locked in a loss. That's why it doesn't make sense to make that decision early. Only do it when you absolutely have to in the last week, because that also means that you've extracted the extrinsic value of the call that you've sold so that you've maximized your return on the short call piece, and then you make your decision as to whether you want to roll that cover call or not. William's asking, what do the colors on the graph mean? Red, yellow, green. So the colors on the graph simply reflect the 1 month and 6 month trend of the stock and how that's changed over time. So as you can see, Apple stock was quite bearish here throughout November, December, and then here in mid-January, things started to turn around. Trend quality started to get a little better. And once it broke above this minor resistance level around 169, 159 or so, once it broke above that, trend quality resumed back to positive or bullish bias. And as you can see, the stock has basically remained in that bullish trend all the way through and turned fully bullish back here in mid-March. So that's what the colors on the graph means. Michael saying, rolling to a diagonal is rolling to a higher strike price and different expiration date rather than the same strike. Yeah, so sorry, I don't remember what the original question was. If I had stocks I do not want to lose assigned 2 weeks prior to expiration. Yeah, so absolutely. If you don't want to lose it, that's exactly what you would do. You would roll it to a higher strike on a later expiration. So yeah, to answer your question, that is correct. Let's see. When do you expect to have real-time quotes? Really good question. It's something we've been working very actively on. It's something that I hope to have an answer on by the end of this month, actually. And we're trying to be able to roll out real-time quotes to everyone for no additional cost. That's really what we've been working on, is trying to limit the cost of market data. Market data is very expensive, and not only for us, but also we know for you guys. So we want to offer a lower cost option for that. So that's something that I hope to have an answer on by the end of this month. Let's see, I believe I already answered that question. Can you talk about how to unwind Amazon position if the options you sold get called away? Well, if the options you sold gets called away, then you've lost your Amazon position. So that takes care of your position. So it's like placing a limit order, and if the stock closes above your limit order, you lose the stock, right? So same thing. When you sell a cover call and the stock expires above that strike price, you simply lose the stock position. So it just automatically leaves your account, and you realize the profit on that stock. Frank's asking, your trade quality score shows 94 for 100 shares, but only 79 for the call, which you chose as a base for PMCC strategy. Why that? So we only talk about poor man's cover call because you don't have you don't have the money to buy 100 shares. So it has nothing to do with the risk profile. We're not saying that the calls are a better risk profile than the stock, but sometimes you just don't have enough money to buy 100 shares of Amazon. You might only have enough money to buy that call. So that's why we compared those two strategies. How about using a stop loss, taking into account the ATR? Absolutely, you certainly can do that. There's nothing here that stops you from using a stop loss strategy on this. The only thing is that if you take out the stock based on a stop loss, you have to close out the call, because then you have a naked call that you would have to post margin for doing so. So you can do it, but just be careful, because once you sell your stock, you have a naked call position. Before buying a stock and cover calls, should I sell a naked call first, a naked put first? So I think actually I answered that question already. I 100% advocate for those types of strategies. Is the option pricing quote delayed as well? Yes. So options and equities are delayed 20 minutes. Bernard's asking, is it better to buy a stock at 100 and sell one cover call, or buy stocks at $10 and sell 10 cover calls? So there's really no difference between those two, because all you're doing is a dollar amount. It doesn't matter how many shares that you own. In my opinion, one is not better than the other. I think it's more, which one would you rather have? In terms of which one do you think is going to increase in value more, the $100 stock or the $10 stock? That's what you should decide. Can you use options play for optional ETFs? Yeah, you can use it for any optionable symbol. You can use cover calls for. Let's see. Raymond, tomorrow I renew my annual subscription. It is 1 year since I've started learning options trading. Congratulations, Raymond. I know you're on our webinars very, very frequently, pretty much every single week. I'm really happy to see you guys come back here every single week to learn more about options trading. And for those of you that are brand new or starting your learning process, take a look at a user like Raymond, who's been with us for a year now and has really learned a lot and participated every single week. And I feel that, Raymond, you've really come a long way in understanding these option strategies and deploying them for your portfolio. So congratulations again, and I'm really looking forward to having you for another year. On a watch list, can you sort alphabetically? Yeah, absolutely. Click on the company name and you can sort it alphabetically. I'd sorted it alphabetically by the company name, not by the symbol, just so you know. Thank you, Raymond. Thank you so much. I really appreciate all the kind words. Frank, in your question about buying the stock at $100, selling the 110 strike, and if the stock goes down to 85, you're right. If the stock drops to 85, the biggest risk that you take with the strategy is you bought 100 shares of the stock at 100. That's the primary risk that you're taking. The cover call is just adding additional yield to the stock that you already own. It's not meant as a way to somehow magically offset the risk that you have of buying 100 shares of that stock. You still have to assume the risk that you take with buying that stock. What we're saying is that you have less risk if you sell the cover call than if you don't sell the cover call. So I hope that you understand. Yes, absolutely. If the stock drops $15, you're going to lose money. There's no way around that, unfortunately. If there was, I'd be teaching it to you. Some of my stocks do not have a score. Why? So if you're doing some small caps stocks, we don't score all stocks. We generally avoid some of the smaller cap names. If you have a specific symbol in mind, I can take a look at that. But most of the small cap stocks we do not score. Raymond, I'm really happy to hear that in that last year, you started knowing nothing about options trading. And I think a lot of viewers here can kind of relate to that, coming to options play, not knowing a lot about options and just trying to learn. And I think that's what most of you here are on this webinar for, is to learn more and make sure that you really understand what you're doing before you place that trade. And that's really why we're here every single week, week after week, with our platform, showing you different techniques, showing you different strategies, so that you learn the different strategies, learn best practices, but most importantly, actually have a platform to view and analyze these strategies that we're showing you. Alex, ETFs don't pay much premium. Is there a rule of thumb when the option's not worth it? Like I said, the dividend yield is your rule of thumb. So if you're looking at MJ, it's trading at 1.74% dividend yield, but this ETF pays 11.87. Certainly something you should look at. But Vanguard, the ETFs, so these don't pay a lot. 1.7% dividend yield. You're still getting 3%, which is not exciting, but still you're beating the yield. I think some stocks like IBM, where you're getting a 4.5% dividend yield already, and as you can see, this cover call yields only a 0.35% yield. That's when you're saying it's not worth it. So look at the dividend yield. That's your rule of thumb. One last question before I wrap this up. On March 12th, I followed your advice to buy an Apple call at 180 and sell a 195 call. I closed the position today and made a $502 profit. So can I now register for 1 year? So now I can register for 1 year of options play. Bernard, congratulations. I'm really happy to hear that a single cover call that you sold paid for your yearly subscription to options play. And I have so many of these stories of users who sold cover calls to cover the cost of options play. If any of you come to the Traders Expo or the Money Show that I speak at every single year, I'm happy to introduce you to a lot of these users that come up to me and tell me, about the cover call programs that pretty much everyone should be utilizing, that helps you generate your income stream for these for paying for options play. So congratulations, Bernard. I'm really happy to hear that story. Okay, I think that's the end of the questions here. Thank you so much, everyone, for taking the time out here this afternoon. I know I went a little over time as usual, but I did have a lot of questions here today. Paul's saying, year to date, I've made $10,000 on cover calls. Congratulations, Paul. That's an amazing number. That's paid for your options play subscription for the next 20 years. So again, congratulations to all of you that have successfully utilized this tool to help you find these opportunities and make this process as easy as possible. If you have a portfolio with equities, this is a great way to add yield to your portfolio. So thank you so much for sharing your stories with us. It really makes me happy to hear that you were able to find value in this tool and the education that we provide and generate some yield for yourself. So thank you so much for sharing. Thank you so much for taking the time out this afternoon. I will be back here next Thursday with another webinar. So I will send out the recording to everyone in about half an hour or so. So look out for that. And I will see all of you next week. Have a great afternoon.